Thanks, Sam. Good afternoon to everybody out there, and thank you in advance for taking a couple hours out of your busy days of reading proposals and figuring out new disclosures and wondering how UNAP's going to impact your lives to listen to the next big issue, or I guess I should say one of the continuing big issues that is on our plate, and that is how to deal with servicing. Now, today we're going to talk particularly around how you handle mortgage loan servicing as it applies to the foreclosure process. And we're talking asset recovery, loss mitigation, foreclosure, however you structure that process in your bank, and that's what we're going to talk about today. Now, there are a couple things that we are going to concentrate on. If you look at the second slide page on your screen, our basic agenda, we're really going to concentrate on how these types of things are going to impact us as banks. In other words, I'm not going to go through the down and dirty history of the foreclosure settlements and how it happened and all the history behind that, because that is history, and we're more concerned about what we have to do about it and how that's going to impact our day-to-day compliance efforts and really what the examiners are going to expect from us in regard to our bank's foreclosure processes and so forth. So you see on page 2 the three major areas that are impacting mortgage loan servicing and foreclosure. We have the settlement agreement, we have the financial remediation framework, and then we have the CFPB's latest proposal that will impact both Reg Z and RESPA to deal with loss net and foreclosure. Now, the provisions that impact the asset recovery and foreclosure processes are principally in RESPA, so that's what we're going to focus our time on here today. Reg Z is more the periodic statements and some of the mechanical aspects of servicing, where the RESPA proposal really contains what you have to do with regard to a distressed borrower and one that may be heading down the road to foreclosure and what you have to do about that. So that's really the roadmap of how we're going to address things today. But again, I'm going to couch everything in terms of this is what it means to banks today of all shapes, sizes, regulators, and so forth. And the continuous message that you'll hear me preaching for 2 hours is we're talking about the settlement agreement and the remediation framework simply because these are the guidelines and previews of what national servicing standards are going to look like for everybody. Whether you're a large servicer, whether you're a small bank that services just your own portfolio loans, or anywhere in between, the principles and mandates that are going to come from these various activities over the past couple of years is really going to serve as the baseline of what we're all going to have to do. And the CFPB's proposal, particularly under RESPA, is really the first step in that regard. I don't think the Bureau is done. There are aspects of the settlement agreement and the framework that are not yet addressed in regulatory fashion. So whether the Bureau chooses to further amend Reg Z and RESPA to require some of these things or just issue it in the form of guidance or enforcement against institutions that it thinks are not doing things the way it would prefer them to do, that's what I think we're going to see. So bottom line, the more you hear about all this information, the more I become convinced, at least, that most, if not pretty much all of the requirements that are being imposed on the largest servicers in the country will, at least to some extent, if not all the way, will be imposed on all of us as servicers, regardless of the size of our portfolio. So let's dig in here and start talking about these things. And as we talk about both the history, and I'll be very brief with that, but also describing the aspects of the settlement agreement that are applicable to, in this case, the 5 largest servicers in the country, think about how you would handle these things. In other words, if this settlement were imposed on your bank, would you have the resources, the capacity to be able to do these things? And if not, what would you have to do to make it so? Because, again, I think that these requirements will eventually be imposed to some degree on pretty much every bank in the country. So it might be one of the more long-range planning efforts that you have in your bank to figure out how to do these things. But I do think you need to think about them and maybe at some point go talk to senior management or even the board to say, we need to pay attention to the settlement agreement and what's happening to the largest services in the country, because eventually these requirements are going to apply to us, and here's what I think we need in order to make that happen. So if you go to slide page 3 and you're looking at how this all bubbled up, And, of course, you could just say 2 words, mortgage meltdown, and that's the explanation of how all this came about. Now, whether you think that errors and gaps and mistakes in the actual foreclosure process and the robo-signing debacle and all of that is a proximate cause of some of the mortgage difficulties we have, or if you think it was just an opportunity for the federal regulatory agencies to seize upon an area that was fairly lightly regulated or anywhere in between, doesn't really matter. In other words, we could debate the politics of this for the next 2 hours, but that doesn't really do us any good because we're going to have to do what we're going to have to do anyway. But you look back at what happened, and it's instructive to understand the motivation of the foreclosure settlement because it explains what types of practices the regulators are now trying to prevent. And it really started at the state level, where state attorneys general were looking at situations and problems with the foreclosure, the amount of foreclosures that banks were having to deal with. And it was literally a tidal wave of foreclosures that banks were just unable to be able to handle out there. And the AGs felt that services were not focusing nearly enough on offering some sort of loss mitigation alternatives before borrowers get to foreclosure. Another theme you're going to hear me state a couple times here, and really one of the most important takeaways I think you can get from this session, is that your institution ought to take the attitude that foreclosure is the absolute last option that you want to pursue. Now, you're thinking, well, we would do that anyway. You know, we don't want to foreclose on properties. We don't want to be the proud owner of yet another home. We're not in the real estate business. We're in the banking business. Well, the agencies want to see efforts towards offering some sort of loss mid, whatever that might be, whether it's principal forgiveness, rate reduction, payment holidays, outright modification, or forbearance, any one of a number of options. We're not going to really talk about what types of loss mid efforts you have to offer because we're not there yet. Now, we may get there eventually through CFPB rulemaking, but the theme now is you ought to be able to show your regulatory agency, your examiners, that you do offer options to avoid going to foreclosure, and you pursue those options before throwing up your hands and saying, I've done everything I can for this borrower. There's just nothing more I can do. We have to go to foreclosure. That's what your examiner is going to want to see here. Number 2, no matter how quickly these servicers acted, the modifications that were implemented were insufficient. Now, whether you blame the actual servicers, excuse me, or you blame the government's fairly dense HAMP program and process to be able to get some of these modifications, the end result is the state AGs, the federal regulatory agencies, and others are blaming the servicers for not acting fast enough and essentially dumping a lot of borrowers into foreclosure when they could have been saved. And then, of course, there's also the UDAP impact. Like I mentioned before, UDAP is the gray cloud that overhangs everything that we do in compliance these days. But there's an element of UDAP here as well, and a lot of distressed borrowers just receive poor customer service, and likely that's because of the avalanche of distressed borrowers that there were calling into their banks and saying, I've got problems. But the bad service they had was really unfair and deceptive. Now, you notice I only have 1A because this predates Dodd-Frank and the introduction of UDAP with 2 A's, of course. But they're thinking about how customers were treated unfairly because of the things that servicers and lenders did not do. So let's get into the actual guts of the settlement agreement here, starting off on page 4. There are really issues that really bubbled up as an investigation of the 14 largest servicers in the country, and there were a number of findings of that. And if you remember, these 14 servicers, these are the ones that are now subject to the effort that you hear about in the press that independent consultants have to come in and evaluate these 14 largest servicers. Fair disclosure, I work for Reliant Risk Advisors. We are one of the independent consultants that works for the 14 servicers here, so I won't tell tales out of school, but we do have a unique insight as to what's going on with the foreclosure settlement and what's it going to mean to all of us banks here going forward. But this is the one where borrowers can call in to see if they've been treated unfairly or if there's something they can do and possibly get some monetary relief from the agencies as well. Well, the investigation found that there were a number of unsafe and unsound practices and a number of weaknesses in various processes that servicers had regarding foreclosures and loss mitigation. Whether it's a foreclosure governance process, and this is really robo-signing and not having the proper documents and the proper authentication, and those types of issues regarding documentation, the preparation processes for that, and this is more of a legal issue when a servicer would take a borrower.